Okay, thank you. Welcome everyone to this panel on offshore drilling. If everybody can have a seat, we will start. My name is Tommy Johannessen. I cover drilling on the research side in SB1 Markets. I will be the moderator for this session, which we'll divide into two parts. We will start with a floater session and then move over to jackup and opportunities. So we will structure this as first having presentations from each of our panel guests, and then we will move over to a panel discussion at the end. So our first speaker is Richard Barker, CFO of Noble. Richard has been with Noble as CFO since 2020 and worked 15 years prior to that in investment banking in various finance roles. So Richard, please, floor is yours.
Thank you to SpareBank for having us today. We should have some slides here. Can we pull the slides up? Awesome, thank you. So we posted a new presentation to our website today, and so I'm going to talk to just a handful of those slides today. So if you could, oh sorry, there's a clicker here. There we go. Okay, so just on some key financials around the company, post the merger with Maersk, we have 31 rigs. Market cap today is just about $5.5 billion. Our trailing EBITDA, so the first quarter as a combined company, was Q4. If you annualize that Q4 EBITDA is about just $0.7 billion. We have a strong backlog of about $4 billion today, and we have what we think is a very conservative balance sheet with net leverage of less than half a turn. Before talking more specifically about Noble, I wanted to talk about the macro backdrop, and I think the title of this slide says it all from our perspective. I think from a macro perspective, our view is liquids demand is widely expected to increase over the next 10 plus years. Our industry is structurally underinvested. It's been underinvested for a long period of time. And our view is that the wells that will get drilled are those with the lowest lifting costs and the best carbon footprint. And those are offshore. So we're very, very excited about the outlook. As you put that all together, our view is, and we're seeing this with our customers, capital budgets are up meaningfully year over year, and more wells will get drilled in 2023 than they were in 2022. That's on the macro side. If you look at on the offshore drilling side more specifically, we think it's an incredibly constructive setup. You have a tier one drillship market today that is effectively sold out. You've had a much more consolidated sector. Obviously, M&A has been central to the Noble strategy. But as we sit here today, you have the tier one drillship market, which is controlled. 65% of that tier one drillship market is controlled by three parties. And capital access for new entrants is structurally different than what it's been before. So our view is we're starting a multi-year upcycle from really last year. We have growing rig demand. We have a rig market on the floater side that is essentially sold out. And we have day rates today in the $425,000 to $450,000 range. More specifically on our fleet, we have 31 rigs. It's a very high-spec fleet. We have 18 floaters, majority of which are tier one drill ships. We have 13 jackups, which includes 5 ultra-harsh jackups in Norway. It's one of the youngest and highest spec fleets in the industry. And we'll talk more specifically around the numbers on the jackup side in a few pages. As it relates to our backlog today is about $4 billion. $2.7 billion of that's on the floater side, $1.2 billion or $1.3 billion on the jackup side. We have excellent exposure to current market rates. So as you look at our backlog today on the floater side, essentially the average day rate across our backlog on the floater side is about $400,000 per day. And about half of that 24 days are still uncontracted, which means we have fantastic exposure to the market. As you combine the backlog and our ongoing customer conversations, it gives us great confidence in the market outlook from here. We get a lot of questions about the transaction with Maersk. We closed that on October the 3rd. We're about 5 months into that now. The integration is going very, very well. It's very much on track. We had plenty of time, I guess, fortunately and unfortunately, to plan, just given what happened in the UK. As we exited 2022, we've realized about $50 million of synergies, and we're very much on track to realizing the $125 million of cost synergies within 2 years of closing. On our earnings call for Monday, we put out 2023 guidance. These are the ranges from a revenue perspective: 2.35 to 2.55 billion, EBITDA 725 to 825 million, and CapEx of 325 to 365 million. Important to note that about 65% of our EBITDA is second half based. On the jackup side, we will not see much contribution to our earnings this year from our jackup side. Only about 10% of the EBITDA is from our jackup fleet. So we think there's huge upside optionality as the North Sea market continue or recovers from these low points. We hope and expect to see that starting to come into our numbers when we move into 2024. So in summary, we're very excited at Noble about the offshore industry and the role that we can play in it. We think it's arguably the most favorable industry setup here for 20 years. We have what we think is a high-spec, a market-leading fleet of scale. We have a great balance sheet, we have strong backlog, and we're generating cash flow. We're also committed to executing on our return of capital policy, which obviously we announced back in October. So we're very excited about the market. We think from a capital return policy, we're focused on share buybacks. We think just given where our stock's value today, we think that buying back shares makes a ton of sense. So with that, I'm 1 minute over. I apologize.
Thank you, Richard. Next out is Transocean COO Keelan Adamson. Keelan has been with Transocean for 28 years, so long experience. Experience with both operations, rig management, technical and engineering, and now a COO. So please, Keelan.
Good morning again, everybody. I'm not going to put up my last presentation. I think I punished you enough with that this morning, so maybe I'll just talk to the high points of that particular presentation and follow Richard. Pleasure to be with you all. Pleasure to be with the offshore drillers here on the panel. Talking what we believe is obviously a very, very strong sector at the present moment in time, and a lot of growth. I'm going to go back to one of the slides I showed this morning, which was on the investment in deep water and how compelling it is. It makes a lot of economic sense. The break-even rates for working offshore are very strong in the $40 per barrel range. The IRRs are averaging at about 30%. They're low carbon barrels offshore, which is really important to continue to reduce our footprint and to have clean energy sources. But I think the main point that came out of that slide was the payback periods. The offshore, and particularly deep water, has dramatically changed in terms of its payback periods, and the simple payback, cash on cash, is much more improved. And I think that was largely driven by the onshore efficiencies that were done in the past, and that's definitely transferred over to the deep water offshore segments, and we're seeing a lot more opportunity in those sectors. Transocean, again, we have 39 floaters. We're heavily focused on ultra-deep water and harsh environment. We are operating in, obviously, the Gulf of Mexico, Brazil, West Africa, Asia, and obviously a big presence here in Norway and the harsh environment sector. We're about 8.5 billion in backlog at the moment, and we have 1.8 billion in liquidity. Our strategy has always been heavily focused on technical innovation. We want to own and operate the best rigs in our space. We believe that that's important in order to maintain profitability through the cycles. So when things are poor, we want to own the best assets to improve utilizations. When things are better, like they are and we are experiencing right now, we have the opportunity to create significant value for our shareholders by driving the rates and contract terms even more. We're very focused on delivering safe, reliable, and efficient operations for our customers. That in our space is a real challenge, and especially as we're growing back in our space, we have the challenges that come with that. but we're very confident in our ability to do that as we grow our fleet. We have transformed our fleet over the last 7 years or so. We've divested 76 assets from our fleet. We are heavily ultra-deep water and harsh environment. 39 floaters are all in that sector. And the average age of our fleet is about 11 years. So we are a very young, very high-spec fleet, ready for taking advantage of the current situation. The floating market is, as Richard alluded to, is very, very strong right now. We have been very successful in the Gulf of Mexico, moving the rates over the last 18 months, particularly driving rates with our high-spec fleet. We've had the benefit of having some long-term contracts in that arena, where we've been able to use that and prevent ourselves from chasing utilization and being very focused on where we push our rates. And so we've been obviously using our 7th-gen fleet in the Gulf of Mexico to raise the rates, careful not to take the wrong amount of term, because we believed we were in a rising market, and that played out. And it's now since obviously raising rates into the 4s, the high 4s in the Gulf of Mexico. We're able to lift the rest of the fleet around the world, the 6th-gen fleet that's operating in Brazil and places like that, West Africa. So the market fundamentals are excellent. We believe we're in a sustained upmarket. The ability for the drillers to bring out more capacity is limited by the supply chain. It's limited by how quickly we can get equipment, how we understand the condition of our assets, and obviously crewing. So with that in mind, not many rigs can come back to the market in a fast pace, which means we're in a sustained period of growth for our sector, and we remain disciplined as to when we will bring rigs back out. We will only bring rigs out when the customer is able to cover our costs to reactivate, and that we are adamant about obtaining an appropriate return on that first contract. So bidding discipline needs to happen in our sector, and also reactivation discipline, removing speculative reactivations from our business is important. And with that, I'll close my statements by saying we're in the right spot to generate a good amount of cash flow that we will be able to use to, amongst other things, deliver. And that's all I have. And I don't know if I'm over or not. I think it stopped. Thank you.
Thank you, Keelan. Next out is Odfjell Drilling, where we have with us CEO Kjetil Gjersdal. Kjetil was appointed CEO last year, but has been with Odfjell Drilling since year 2000 in various operational roles and other executive management roles. So Kjetil, please.
And we have a slide also. Thank you, Tommy. Pleasure to be here. Thank you for being invited, Henrik. Enjoy the cooperation and support from you guys for SpareBank. This is a big year for us. It's about a year now since we split the company in two. We are now a pure rig company. And in addition, in February 1973, the company was founded, so we have a 50-year anniversary this year. 50 years of global experience in the rig and drilling industry, and we have seen multiple trends, cycles, and requirements in this period. But I would argue it's a very much a strong and healthy 50-year-old that I'm proud to be representing here today. We have a very competent organization, over 1,300 people now. We have a fantastic fleet of 8 6th-generation harsh environment units, which out of 7 have deep water capabilities. We are capable of drilling anywhere. We can go harsh, we can go ultra harsh, we can go deep water harsh, or we can go deep water. And we have drilling experience from Barents Sea up north, South Africa in the south. We've been in Brazil, we've been in Asia, we've been in East Africa, and we are very delighted with our track record. We do also have a very comfortable financial situation at the moment. We have included some key numbers here to highlight that situation, and I hope that gives the context of the solid position that we have in our company. So if I could leave you with 3 things here today that has really helped us to deal with all these various ups and downs over these past 50 years. We have had and we will have a determined focus on innovation and improvement of our fleet and workflows. We have a focused stance on cost control and financial discipline. I think that's really important going forward. And we do have superior operational capabilities and efficiency. These are 3 core tenets, out of which they all rely on each other, and we have recent examples of all of them. And I think you need all 3. If you take one of them, you are kind of in trouble. For instance, we have invested $50 million in carbon reduction initiatives on our rigs. We have set a very ambitious target of 40% reduction by 2026. These investments, they pay off. They deliver what they promised. So we're already on target and taken down emissions 35%. And we've set a very ambitious goal on net zero by 2050. Have to admit, a rig owner having a net zero ambition, is that possible? When we first started talking about it, there's no doubt in my mind we will get there. We have the solutions, we have the engineering studies, they were completed. It's all about finding the right business cases. We do have a high financial utilization and cost control, which I think our previous quarterly reports has proven. And that has also been very important for us during the downturn. We were able to keep our fleet busy as one out of very few, and we actually managed to pay down debt also during the downturn. And we are very pleased with that. And when it comes with our operational results, and I would say client relations, that has led to an expansion of our fleets with high quality assets and given us also new contracts. Last slide. I think this gives a very good picture of where we are today. Of course, we have a very strong base here in Norway. Harsh environment here in Norway will always be very important with us. We have good relations with key clients like Equinor, Aker BP, Neptune Energy. So we will continue to work with them going forward. But I also see that given the flexibility of our fleet, we have the opportunity to pursue opportunities elsewhere. And we have done that. We have taken recently the Deepsea Bollsta down to Namibia. It's working there for Shell now. We will add that with one more rig in just a couple of weeks. We'll take the West Mira down to that area. And we will take the West Hercules to, not the West Hercules, the Hercules to Canada for ExxonMobil. I think this shows a very interesting picture, and I think it shows the strength and flexibility that we have in our fleet. Thank you very much.
Thank you, Kjetil. Then we have Seadrill with CEO Simon Johnson. Simon has been in the industry for 25 years, working in Noble, Diamond, Borr, and now Seadrill. Joined as CEO in March last year. So please, Simon, the floor is yours.
Thank you, Tommy, and thank you for SpareBank for inviting us to speak with you today. We don't have any slides today, but I thought it'd be a good idea to give you a bit of a recap of what we've done in 2022 over the last 12 months since we emerged from Chapter 11. We relisted on a number of stock exchanges, as people will be aware. We've undertaken a major headcount reduction of our onshore staffing by around about 25%. And then we also conducted a divestment of our Saudi jackup operation, which obtained a market-leading valuation and also allowed us to massively deleverage our balance sheet, and the balance sheet we emerged from Chapter 11 with, that is, and that rendered us that transaction zero net debt. So obviously, a major change to how the market sees us. And we did that by crystallising the arbitrage between the implied value of those rigs in our balance sheet and what we were able to realise in the open market. And I think that's an example of a level of value creation you should expect for us to continue with in terms of future opportunities to do similar kinds of things. Towards the end of 2022, Christmas came early for us with the Aquadrill transaction. That saw us add a number of rigs to our fleet. Today, on the combined pro forma case, we have 30 rigs at our disposal. There's 23 that we will own and operate once we close the Aquadrill transaction, and there's the 7 that we operate either on behalf of or in conjunction with others. That Aquadrill transaction delivered scale to our business. We believe it gets us to the minimum efficient scale of operation necessary to be an efficient international driller going forward. And it also unlocks material synergies that were locked inside the Aquadrill structure. And the run rate there is going to be around about $75 million per annum going forward. So, really a significant transaction for us. So I think, last year, the general theme is that we met or exceeded expectations of us from our financial audience through the year. And what's ahead in 2023? Well, more of the same. So we intend to continue to deliver on our promises. We think we have a short but enviable track record in that regard. What we say we're going to do, we deliver on. We have 4 rigs that have just commenced work in Brazil. They were the recipients of massive sort of capital allocation in 22 for us. And they're all working for clients, Petrobras and Equinor. I would say that we're pleased that we reactivated those rigs when we did. As Keelan alluded to, we're starting to see strong headwinds now in terms of access to specialised service chain personnel, in terms of technical support, availability of critical spare components. That's becoming a theme. It's not something to sort of lose too much sleep over at the moment, but certainly when we look at the few number of stacked units we have in our fleet right now, we believe there's going to be practical problems in terms of meeting budget and obtaining precision in terms of project delivery times as that supply chain comes under consistent, sustained pressure. We are looking to close the Aquadrill transaction here towards the middle of the year. You may have seen a recent announcement. We've cleared the antitrust hurdles that were there, and we've also filed our registration statement, which is an important part of the pathway to issuing new shares to the Aquadrill shareholders. Ahead of us this year, we're looking at refinancing debt opportunities. The credit market's opened in spectacular fashion with the Transocean transaction earlier this year. So obviously that's turned everyone's eyes to how they might sort of obtain better coupons. We have around about $500 million in debt that's still there on our balance sheet, notwithstanding the fact that we're zero net debt today. And obviously that's expensive debt, and we're looking to see how we can best reduce that burden on the company in terms of interest support going forward. So for the rest of the year, you can expect us to be as busy as we were last year. We're going to continue to simplify our balance sheet. We're going to continue to simplify the company and our fleet as well. And also, I think more generally, our investment proposition to the market. We have an excellent management team. I think one of the undiscovered jewels in the Seadrill box has been the quality of the management. I think for many years people thought the principal shareholder that previously controlled Seadrill was the guiding light and the force behind a lot of things that were done. They were certainly important in terms of access to finance, but I think there's a hidden resource which we're in the process of unleashing in terms of the quality of the people who are in the company today, and that's been a fantastic sort of discovery for me as someone new to the company. We have a growing fleet. Our fleet, as I mentioned, is now at 30 units in terms of owned, operated and managed units, and we are going to be focused on continuing to deliver value. So an exciting 2023 ahead for us. I'd like to echo the comments of Richard and Keelan as well. I'm in violent agreement with them about the macro fundamentals that are driving the business forward. We're very excited about the future, and we're sort of focused right now, though, on making sure that we deliver good operations. One of the paradoxes of this business is when we make the most money and the financial side looks good, it becomes harder and harder and harder to deliver where it counts at the rotary table. So that's something that we're very much focused on. If you like, there's a sort of a dual focus. One is going to be on creating a pathway to capital return in similar vein to some of our peers, but then also we're continuing to work on and develop safe and efficient operations, hopefully with an insulating blanket against some of the headwinds that we face, having been through previous market cycles. So that's all I have for now. Thank you very much.
Thank you, Simon. Then we can welcome our 4 floater panelists to the stage, and we will discuss some key industry topics.
You want us?
So our first topic is on the market balance and day rates. So we've seen day rates soar across several rig segments, and in the drill ship segment, we've seen day rates surpass 400,000 up to 450 over the past 6 months. So the first question goes on the road ahead for day rates, and we can start with the drill ship side maybe. What's your view on drill ship day rates through 2023 and into 2024, and what will be the drivers of that? Keelan, you want to start?
Try to not sit in the end. Yeah, so obviously we believe rates are going up. We're seeing, obviously, with the Brazil growth that's taking place in a massive way at the moment. We're seeing a lot of the capacity that's available internationally that's active going towards that region, and obviously it's commanding higher day rates. You've seen those fixtures yourselves in the high fours. There's a lot of cash to be injected into that, and that's supporting why the rates are so high. But then go back to the Gulf of Mexico, and the conversation is, when are we going to have a 500? And I think as an active fleet, and you think about the challenge that we're going to have in not only the cost, but also the speed to which we can bring the rest of our assets to bear, it's going to take us a little while. So I would expect rates for that reason to go up even more in the near term. Simply on the capacity basis.
Yep. Simon, do you agree? Do you expect 500 this year, or is it too early?
I think it's possible. I think you see here 4 of the more disciplined players in terms of setting correct financial thresholds for reactivations. But there are a number of players who have got fleet that are sitting on the sidelines that they're looking to reactivate, and really a lot depends on them and their behaviour. For ourselves, we have a very full contract schedule relative to most other players. So we're quite comfortable, at the margin, pressing the advantages that we have with that, that small amount of capacity. We're very comfortable with the demand and the market potential to get a contract for those rigs. So we can afford to play a bit more aggressively than most. But like I say, it's unfortunately in any market for a capital-intensive commodity, unfortunately you're somewhat at risk of the behaviour of the lowest common denominator. So it's really all about whether people stay focused and disciplined. And as I say, I think you've probably got 4 of the most disciplined players here, in my opinion.
Yep. Richard, Noble had a pretty positive Q4 call the other day. Do you have anything to add on the drill ship side?
Look, to me, it's very simple. It's supply demand. We got a tier 1 drill ship market that's basically full today, and we see incremental demand of 12 to 15 rigs over the next 12 to 18 months, maybe more. It's simple, right? So under that scenario, we see day rates going up, and we do think there'll be a 5-handle fixture this year.
Perfect. Harsh environment has been lagging a bit the international deep water markets, but you're seeing that also catching up now. So what's your thought going into this year and next year, Kjetil?
Yeah, it is increasing. We're typically a bit more maybe cautious, but it's definitely between 400 and 500 is what we see. One thing I would like to add, one thing is day rates, but contract lengths is also vital in this. Are you able to add substantial length? And you avoid these short idle periods between contracts, which is very important because you're just burning cash. So it's a combination, day rate, contract length, and back-to-back work, which is going to be important.
And by region, you've seen South America being in the forefront of the demand recovery so far, but West Africa is increasingly picking up now. So can you share some thoughts on the views in different bays and what will be the demand drivers, maybe beyond also South America? We have had some very good results out of Namibia, for instance. How can that be the new Guyana, do you think, Kjetil?
It could be. I think it's too early to say. I think we will know a lot more about this time next year. There's a lot happening in that area in 23. We have 1 rig down there now. Soon we have 2. There will be another one with Total. There's going to be a lot of exploration drilling, testing, so a lot of answers will come in 23. But I think we all have noticed, they're quite excited about that area, so I wouldn't rule out that will be a very important hotspot going forward.
Perfect. And then we can move a bit over to the supply side and the market balance. Now we're seeing floater supply down around 40% since early 2015, and with demand now increasing, are you seeing clients becoming worried about access to capacity, or are there conversations with your clients changing?
I think there's an element of that. I think at the moment the clients are prepared to pay higher rates to not commit too long. I think that's an important theme. I don't believe that they're worried about getting capacity out in certain markets. They are, like the Gulf of Mexico, but I don't think their projects are just getting pushed out and coming under timing pressure. But I think I know where you're heading. Is there going to be the prospect of any new building? We're so far away from that. It's just not funny. If you do an inflation-adjusted calculation for what triggered new building in the last cycle, we're not even halfway there, in my opinion, to what would encourage someone looking at that kind of activity. There's no natural constraint to rate development from where it is today to where it might get to, in my estimation. So I think there's no shipyards that want to build rigs. There's no operators with the visibility in their own near-term projects. You're basically in an 8 to 10 year visibility in order to commit to a new build with sufficient term that can recover the capital that will be deployed. And the cost of a new building is so incredibly high, and where you're going to get the financing terms, you certainly won't get it from the yards anymore. So I just think this idea of there being, we're somehow on the path to a new building possibility, I think it's facetious. It's certainly not going to happen in our company anyway.
Everybody agrees, or?
Yeah, totally agree. You can't make that go up at the moment. It's impossible.
So then the question is, reactivation will be, of course, some of the incremental supply. What's the current cost estimates, time to market, and the discipline of further reactivations? Because obviously, Keelan, in your presentation, you talked about a 13 rig shortfall only in South America. So where will the supply come from, and how will that look like?
So clearly, let's take a more macro view in the floater situation in the world. In 2014, there was something like 324 floaters in the world. Today, on paper, maybe 180. Maybe there's an effective supply of about 155, and today there's 125 working, something like that. So there's a capacity to come out. The issue is, how can drilling contractors fund it? It's very expensive. Everybody's got a different price range, but suffice to say that needs to be recovered from our perspective, and I think from all of our perspective, needs to be recovered in the contract. The challenges we have is that the OEM suppliers during the downturn, they had to restrict their capacity naturally. And so the entire supply chain, whether it's from the downturn or whether it's from the Ukraine situation, the European situation in terms of getting forgings and electronics and components like that, is we've lost a degree of reliability and also capacity in that sector. So I think Simon pointed it out in his presentation. We've got to be. It's going to be a slower process to bring out our ultra-deep water fleet, and it's not only from a supply chain perspective. It's also going to be from a people perspective. We've got to train. We've got to bring new people back to the business. We've all lost really talented, experienced people during the downturn, and I don't know if they'll all come back. We'll be bringing some new people back into our exciting industry, I would say, but that's a challenge in itself as well for the entire group. So I think it's a measured growth back, but all the same, I think I would add another comment, and then I'll get off. We've done this before. We know how to do this. I think the difference now is that we're going to be a lot more financially disciplined in our approach.
Good. And on SPS schedules, there's quite busy SPS schedules in both 2023 and 2024 for several players, including some of you. Can that impact the market balance in some way? And are you worried about the cost inflation, yard availability for SPSs? Richard?
Yeah, sure. We spent a lot of time on our call on Monday on this topic. You know, we see half our fleet going through SPSs over in 23 and 2024. Obviously, there's the capital element to it as well, and we're spending a ton of time planning around that. But then I think on the positive side, if you will, is the impact on supply, right? So if you think about a 10-year SPS, on average, we think plus or minus 30 to 60 days out of service. So if you do that across, you know, the majority of the tier one drill ships, which are generally going to go through their SPSs over the next three to 3.5 years, that has a meaningful impact. Right, so I think that we're, you know, customers are working with us, if you will, to figure out when's the best time to do that. But I think that's maybe being missed right now is just the impact on just fleet downtime and the impact on supply.
Yeah. Kjetil, anything to add?
Yeah, I think if we approached it the traditional way, I would be a bit worried. You have to do it differently. You have to start way much earlier than you used to do. You have to plan accordingly and be very firm on setting the scope of work. But with all those things in place, good planning, it's doable.
Great. And then moving off to the topic of consolidation and capital allocation. Maybe on capital allocation first, with the strengthening market we're seeing now, are you changing your capital priorities? Are you seeing any push from shareholders to now look at growth again, or is it only cash distributions to shareholders that matters? What's your current feedback there, Simon?
Yeah, well, we're probably a little bit further than some of the guys to my right from declaring firm policies in that regard, because we have also a heavy shipyard and capital allocation accordingly for the next 2 years. But yeah, I think, you know, in the same way that we're being restricted by ESG screens because of the industry that we participate in terms of access to finance, you know, we're also seeing similar pressures in terms of our investment proposition with, you know, a new investment audience. And I think increasingly, you know, we feel that we have to be able to deliver a yield story. And also, if you do believe, as we clearly all do, that we're at a point of, you know, inelastic supply going forward, what are you going to do with the money? So I think it's important that you craft a sustainable story about how you might return that capital. And I think in many ways, the story for us is similar to the ones of what you heard for the E&Ps that spoke up here before us. It's about, you know, having a sustainable policy through time. We don't want to just sort of strip the money away so you don't have enough to run the business going forward and to ensure you have a reserve there for unplanned events or industry downturn. But you do need to, I think, be able to demonstrate, not talk about, but to demonstrate a viable process of returning that capital that you can't deploy an adequate, return within the business. So certainly that's something that we're going to be looking at, but practically, you know, with free cash flow is only going to facilitate that probably 2 years from now. So that's, you know, 25 is the first year that we'll be able to do something meaningful in that regard. But we certainly talk about it at a board level and management team level actively all the time. Yep.
From our side, it's probably a little bit more simpler for us in the near term. We've got to delever our balance sheet, and we haven't been able to do that through the downturn, obviously. So any of the cash that we're going to be generating, and we're going to generate a lot from our operations, will be used exclusively in the near term to delever our balance sheet. I would say from a returning cash point of view, our share appreciation in the cycle as it grows with day rates and contract terms is similar to a dividend. So from that perspective, our focus heavily, we're going to simplify our capital structure, delever the balance sheet, and then that'll take us in the next 3 years anyhow. So we'll see after that.
Anything to add?
Yeah, from Noble's perspective, or from an M&A side, we feel like we've done our part over the last couple of years. From a return of capital, obviously that's really important to our story. We're all a function of our history. We announced about a month after closing the Maersk transaction a $400 million buyback program. We've spent nearly 100 million of that so far. So, you know, for us, it's critically important to our story. We're focused more on buying back shares, just given values right now. But obviously, as the market strengthens, and that facilitates our ability to return more.
Yeah, there is expectations. I think our shareholders been very patient, and right now we are going to do the refinancing of the company. We expect to have that completed in the second half. Clear goal for us is to start paying dividend. I think that is due now. So I wouldn't say push, but there's also a lot of interest in growth. So when we do the refinancing now, we're also seeking to get flexibility to look at both dividends and M&As. I think it's also positive that we see a lot of return on generalist shareholders that is getting more interested in our sector. They are very welcome with that, and I think that's a positive sign.
And then on consolidation, on the floater side, we've seen quite some consolidation. But going forward, what do you think? Are the market consolidated enough now, or will you see more to increase the pricing power and reduce costs?
I don't think it's going to stop. Some people seem to think it's behind us. I don't know why. I think, although these are very capital-intensive assets, the way the companies have been run historically is, we haven't been beleaguered with great efficiency through time. And I think part of the solution to us to provide better services to our principal customers is to run our fleets more efficiently through time. And the consolidation, some people seem to think it's about market power. It's not. It's actually been able to run in a more efficient manner over multiple geographies in a common way and at the lowest possible price point. And really, that's what I think is important for the long-term sort of financing of these organisations, to build a resilient company that can withstand the weather systems of the various business cycles that confront us through time. So I think it's actually important that we see far more consolidation than we've seen. If you look at the spread of the total number of units in the worldwide fleet, it's really a small part of that total fleet that have been looking at consolidation opportunities. There's still a number of 1, 2, 3, 4, 5, up to 10 rig companies that are, that's a long tail. And really, those guys need to get taken out. They're not efficient. And, I think I said earlier today, we feel that we've only just reached efficient scale. I think anyone who doesn't have 20 rigs, they're not going to be able to achieve the kind of economies that we see with standardisation of equipment, training systems, the increasingly tough regulatory environments that we face, and converging regulatory environments around the world as well. So all of that means that I think a better service quality is a function of a bigger fleet. And these people who are playing on the sidelines, that's not helpful for what we deliver as an industrial segment.
Kjetil?
Yeah, if you look at our segment, and if you look particularly to the tier 1 6th generations rigs with deepwater capabilities and AOC to operate here in Norway, I think you count 12 rigs and they have 7 different owners. So it does not make sense, nor from an industrial point or a financial point of view. So there's definitely room for more consolidation.
One point I would make is they don't need to be owned. The important thing is they're managed by a small number of owners. I think there's going to be lots of different business models that you may see emerge here in this next little while in terms of who's actually managing the assets. So I think so I should have made that point.
Richard, you have been one of the most active in the consolidation. Anything to add?
No, I mean, look, it's good for everyone. It's good for the company. It's good for our customers. It's good for investors as well. So it makes sense. We can partner more with customers, and I think that's important. So my hope is there's more consolidation. Smart consolidation makes sense. If you look on the land side, it's always been 3 folks: Schlumberger, Halliburton, and Baker, right? So I don't know why our industry needs to stop where it is now. My hope is it continues. It's good for all.
Perfect. That concludes the floater part of the offshore drilling panel. So thank you to all 4 of you. So we will now move over to jackup and opportunities, where we will have the same structure. We will start off with presentations from the panel guests and then move over to a discussion. So we will start off with Borr Drilling, where we have with us Magnus Vaaler, CFO. Magnus started in Borr Drilling back in 2018 and became CFO in 2020. He has held various roles in finance, including in Frontline and OMP. So Magnus, you want to, when people...
All right, thank you, Tommy. Thank you, SpareBank and Markets, for having us here today. So, who are Borr Drilling? Borr Drilling is a leading pure-play jackup drilling company. We have a delivered fleet of 22 rigs, whereof 21 rigs are contracted, which is 95% of our delivered fleet. In addition to that, we have 2 new builds under construction. Our fleet is young, only 6 years on average. We're operating worldwide, with our larger hubs being in Southeast Asia, Mexico, West Africa, the Middle East, and 1 rig in the North Sea. So, why should you invest in a company exposed to the jackup drilling market today? As you can see on the left graph, the available supply of modern rigs is extremely low. We count only 9 modern rigs available, which includes only the competitive rigs in the market and new builds. We also are aware of demand that is double of this, and this demand is also increasing. The order book of new builds is virtually non-existent. Adjusting for rigs already contracted and committed, and rigs that are going to work in China, we count only a handful rigs left at shipyards. This is the lowest level of orders in the last 25 years. The marketed utilization for modern rigs are at 95% after removing rigs that are not really playing in the open market. At these utilization levels, looking at previous cycles, the day rates increases rapidly, with the average being around $180,000 per day. What's different now in this cycle is, like we said on the previous page, there is no order book to speak of that can moderate this long-term pricing. In Borr, we have recently been awarded several contracts in the range of $140,000 to $150,000 per day. And with this graph in mind, we expect this to continue to increase. So with this backdrop, why would you invest in Borr? In 2023, we have around 95% of our available days contracted, which will give us a solid foundation of the earnings this year. In 2024 and 2025, the picture is different. We have half of our operating days available to contract, which we think is a perfect position to be in to take advantage of the current market rate increases that we're currently seeing. Our financial progression from 2021 to 2022 has been significant. The revenue increased by 80% from 21 to 22, and the EBITDA increased by around 300%. For 2023, we are guiding revenues to increase further, to be in the region of $740 to $780 million, and the adjusted EBITDA between $360 and $400 million. So in conclusion, this is what we want to highlight, being the key takeaways for Borr Drilling going into 2023. The asset pool is limited, utilization ratios are high, and customers focuses on contracting assets for the longer term. We're giving clear guidance for 2023, EBITDA between $360 million to $400 million. We have successfully concluded a large refinancing, resulting in all maturities being pushed out to 2025. And our target is to refinance these maturities already in 2024, after which we aim to be in a position to pay dividends. And lastly, our operational team continues to fully be dedicated to manage the safe operation with high operational efficiency to create maximum value for our customers and stakeholders. That's it from me. Thank you.
Thank you, Magnus. Next out is Dolphin Drilling. Bjørnar Iversen, CEO. There you are. Bjørnar joined Dolphin Drilling in 2019 and was previously CEO in Songa Offshore before that, and has also worked in Odfjell drilling for many, many years.
Thank you very much.
Welcome, Bjørnar.
Thank you very much. Thank you to SpareBank the guy and the whole team for organizing it. Could you put on the presentation, please? Okay. Let me see here if it comes up. Here we go. I'm going to take you, we just have 5 minutes, I'm going to take you very quickly through Dolphin Drilling, and let me see. Okay, Dolphin Drilling re-entering the Euronext growth in October last year. Today valued at $150 million market value. We have over 3 standard moored drilling rigs, the Blackford, the Borgland, and the Bideford, and we have the marketing rights for 2 capital assets, which were currently marketed particularly towards the Norwegian continental shelf. Blackford, as we see here, up in the left corner for you guys, soon on contract, underway, mobilization after a 5-year SPS to Nigeria for a 1-year contract with GHL. That contract is basically bringing the company back to positive EBITDA. We are currently heavily marketing the Borgland and the Bideford in the market, and I will zoom particularly in on that market. As you see on this slide, the market consists from land rigs to drill ships, and particularly the guys who was in the panel in front of me here are really, really into the drill ship and the DP submersible side of the business. We are the moored standard semi-submersible company, and you see the zoom there. I would like to zoom in on that market so you get a good grip on that market. 10 years ago, or more than 10 years ago, in 2010, in the middle of the last upcycle, there were 105 rigs on contract, and today we have 23 rigs on contract. Look at this picture. Look the areas where they are. We're talking Norway, gone from approximately 14 rigs, standard rigs, to 0. UK, more or less the same. Gulf of Mexico, the same. West Africa, the same. Okay, what has happened lately? Okay, in the downturn we saw a scrapping ratio going from approximately 140 rigs and down to 36 rigs. Per today in the world, there are 36 standard moored rigs left in the market. That means there's almost nobody left. And let's dive into those 36 rigs. Where are they? Who are they? Here we have the rigs in China and the Caspian Sea, the Chinese one, long-term contracts. We have 15 rigs of the 36 there. We have, per today, particularly in the UK, mostly on contract, some others, West Africa and Mexico. We have 12 rigs, basically, on contract. That leaves 9 rigs left in the market. And if we look at that market, at least 4 of them has very high reactivation cost. That leaves 5 rigs, let's call it free and available, of which we have the Borgland and the Bideford. There's a couple of others here as well, and probably some of them will announce contracts shortly, because if we look at... So now basically we have looked at the supply side of the market, which basically is gone. It's a handful left, and I think it doesn't, I don't need to, to be very foreseeing to say that some of them will sign shortly. And looking at the market, over the last 90 days, we have had 20 rig inquiries for moored rigs. We have received approximately 20. And you see here, it's basically the same pattern. It comes back in the North Sea, it comes back in West Africa, it comes back in Brazil, it comes back in the Gulf of Mexico, it comes back in India, and it comes back in Australia, and partly also Indonesia, Malaysia. That means we see an inflection point shortly. Maybe some of those 20 inquiries are not going to be executed. Maybe some of those 20 will be postponed. But still, maybe some of them will be picked up by larger rigs, like the ones that Kjetil or some of the others have here. But that will be at a significant higher price because the newer rigs, the bigger DP assets, as they just said to you, are talking about day rates around the 400 mark, 350, 450, in between their pending market. So what does that mean? That means we think that there's a high probability that the last 5, let's say, free and available rigs will come back in the market. And our rigs are being kept warm. We are running a smart stack regime on them. So they are probably the ones with the lowest mobilization cost. So we think that this market really comes back. And as an illustration, the day rates, for instance, on the Blackford, which is now going to Nigeria on a 1-year contract, and we also had a letter of award there in the 325 level, has gone from $150,000 a day approximately to well north of 300. So we see exactly the same pattern as I would say Transocean was presenting, Noble was presenting, and Kjetil in Dolphin Drilling was presenting. Sorry, in Odfjell Drilling. I'm converted, you know. Okay, so sum it up. We think, we see the Blackford Dolphin contract start up in Nigeria will give us a positive cash flow. Here she leaves Las Palmas, 9th of February. Here we see many near-term opportunities for Blackford in West Africa, as you saw from the opportunity matrix or dots. And we see a very high increase in the tender activity for standard moored rigs, I would say basically in all markets. So the markets we saw in around 2010, 2013, it's popping back. And it's just, what should I say, it's just underpinning exactly the same pattern as we see from all the others. So increase the tender activity, and we have high hopes that we will be able soon to bring back the Borgland and the Bideford, our 2 remaining units. And on top of that, we're also working on some other business development activities to realize some growth opportunities for the company. And exactly there, I'm out of time. Thank you.
Thank you, Bjørnar. Next out is Scott McReaken, CEO in Northern Ocean. Scott became CEO in Northern Ocean in 2019 and has been part of the Seadrill group since 2012. Previously CEO in Swan Drilling and also CFO in North Atlantic Drilling. Welcome.
Hello. I don't know if it's on. Thank you, Tommy, and Henrik and SpareBank for having us. Yeah, here's the presentation. So 5 minutes, 1 slide. Yeah, where we were at last year, rig coming in, actually the Mira was stacked, the Bolsta coming off contract. Huge difference from this year, I would say. The last 12 months, really 18 months for that matter, have been about de-risking the company. We're an asset owner. We don't manage the rigs. We've outsourced that essentially with Odfjell being one of the premier providers of harsh environment services. Very happy with where we're at. We have 1 rig now, the deep sea Bolsta that we signed on contract with Shell working in Namibia, which we're seeing as really a new emerging harsh market from what we understand. Another ship was down there before. It's had some seasonal issues. There's a current that comes up along South Africa. So the question is can a drill ship go and complete the work year-round, or is it really specified or unique to provide a harsh environment semi into this space? We like to think it is. We like to think, with the Total contract we have with Mira, that we'll be able to prove that. We'll be able to drill year-round with this big design, the CS60s that we have. Very confident with Odfjell's delivery of service there. So far, Shell's been very pleased with what we've been doing. We continue to have very active dialogue with them around what is next, what the exploration wells, what we're seeing good results from their drilling program, and look forward to really a longer time and a longer season out there. I think what we're seeing too with looking at our backlog with the Mira is days, weeks away from leaving Quayside to really beginning its transit and sail down to Namibia as being the first location. What we're seeing, though, is our positioning. We have backlog coverage basically through firm backlog through the end of next year, or end of this year, sorry, and then with the Total contract into next year. It really positions us well. The options are there. The Shell contract are unpriced options, so we're really positioned well to take and reset the rate. We came in with a bit of a lower rate just because we wanted to keep her working as much as we possibly could and minimize the out-of-service time. We're able to achieve that. Looking back, I think it was the right decision. With Total, we got some upfront payments, so we got a balance on the contract there. But really, they're assisting, and so we weren't so much of a burden on the shareholders as we could take some money from Total up front and mobilize the rig. Yeah, so the position where we're at with recontracting, and just as much as you guys heard earlier, somewhere mid-400s, higher, lower, somewhere in that space is around the discussion and what we'd like to see in 24 and 25 continue to tighten and increase. And really what that positions and allows us to do is the next phase and the next step of the de-risking of the company. So it's operational, the Bolster going back to work, taking the risk of uncertainty in budgets and the capital raise that was needed with her. With Amira, where we're at on the de-risking, we've funded it last December. And we feel confident that we've done what we need to do in the capital markets, and we can focus on finishing up the project. I like the sail away picture that Bjørnar had. For me, it'll be a picture of an empty quayside, which I'll be excited to see here in a couple weeks. It positions with the options and the contracts and where we're at, we de-risk the balance sheet as well. So we're able to push the maturities out to 25 on the revolver and the bank facility. We have basically 2 years to put the right strategy on the contracting and the marketing side and to manage working capital through the operations and the rigs. I'm very comfortable and confident, especially as with Shelf and with the Transocean, the different bonds that have come out recently. Seeing that is definitely supportive of the industry and productive and really, a complete change. Just much like Northern Ocean, in the last 12 months, the change has been significant. Not just for the company, but for the market and where we operate and the outlook of what we have. So we're very confident in where we're at today, where we take the company, where finishing out the de-risking of operations and getting into a normal state. And then we get to look forward to other things and try to participate where opportunistic growth makes sense. And kind of move from there. 30 seconds left. That's pretty much it. Thank you.
Thank you, Scott. Thank you. That concludes the presentation, so please come up to the stage for a panel debate. Richard from Noble will also join due to their jackup exposure. So our first topic there, we will also start there on the market balance and day rates. And maybe we can start on jackups since we haven't discussed that yet. We have seen the premium jackup segment has been one of the most active and where day rates have increased the most with fixtures up to now $150,000 per day. So my question is then, what's next for day rates in the jackup market? And natural to start with you, Magnus.
Yeah, thanks. I think kind of everything is in place right now. All the triggers are there to see this still this increase to continue in day rates. Like we showed in our slides, there are virtually no supply of modern jackups left in the market, but there's still a high demand. You still see Middle East has been very, very active, with especially Aramco over the last quarters to fix rigs up to 40 rigs. But you also see that other players in Qatar, in UAE, ADNOC has also had a very aggressive expansion program. So they need to also find rigs in their fleet. So we think day rates should definitely continue up from the levels we've seen, $140,000 to $150,000 per day that we have already fixed for our fleet. And And historically, at these utilization levels, you can see around 180 up to 200.
Are you also seeing other markets than Middle East now coming back, or is it still mostly Middle East?
We still see quite healthy demand from Southeast Asia as well, Malaysia, Thailand, Vietnam. They have had quite a good demand there through the downturn as well, but they still see a lot of interest from that region, and also select opportunities in West Africa and Mexico as well.
What about on the harsh jackup side, Richard? That's been a more subdued market up until now, at least. What's your expectation going forward?
Well, thank you for bringing that sore point up. Yeah, so from our perspective, obviously it's a sore point for our story. Just on Noble specifically, only 10% of our EBITDA guidance this year is from jackups, our entire fleet. So the North Sea is clearly weaker than we expected. I think it's weaker than anyone expected. We don't see that necessarily changing in 2023. We are starting to see signs of that changing in 2024, especially on the ultra-harsh side here. So I think we're quietly optimistic what we think is a low point today, but I think we're starting to see signs of that turning and really expect to see that to start to turn in second half of 2024.
Perfect. And across all the rig segments, basically, there's been, you've seen several rig segments at least, that the premium part is sold out, or virtually sold out, and that older assets are starting to catch up on rates. So just, Bjørnar, your thought around old versus new assets, and if you can see older assets day rates soar going forward?
Yeah,
maybe a leading question, but...
For sure, that was a very leading question. And if you listen to the panel before us and the rest of the panel here, of course, the tide is lifting all the boats. So if you have like the premium one sold out at 450, some of the guys are talking about even about 5 handles here. Of course, the rest of the market comes, and typically on the moored standard segment is typically 100 to 75,000 below the DP premium market. So everything is being lifted up, and that's what we see. And as I mentioned, we had our Blackford that came off a contract with Pemex around the 150 mark, now way north of the 300, including mobs. So yes, it's coming, and it's following basically the rest of the market.
Scott, anything to add on the market? You mentioned 4 to 450 recontracting of day rates.
Yeah, I mean, for us too, I think we're seeing from where the drill ship, ultra deep water drill ships is always the kind of the more trending mark that you see in the industry. For us with the semis, specifically the harsh environment and the high spec semis, the 6th gens that we have, there's a kind of an implied discount historically into that, and probably more because of the business model operating in the North Sea and the cost and the basis there. But really that's closing. I would say we're able to, when we looked originally putting the rigs back to work, of course we focused here, we focused the UK and Canada, and then slowly, somewhere around like half a year ago in the summertime, they started, the bigger super majors started coming and asking, hey, can a semi do this work for us? In kind of benign environments as well. So we wanted to stick with where we thought we could create the most value in the longevity of the rig, trying to stay in the harsh play. And that's why Namibia is actually really interesting for us as well, because with that in South Africa, both back on pretty much the radar of the super majors, they're able to continue to operate in a harsh environment like that, and we should see a kind of reduction in that discount and really priced about the same, because they are capable to up to 10,000 feet to be in those places, and we're even looking at different strategies to say, yeah, what does it take to go to 12? Let's narrow the difference even more on the CS60 and see what we can do.
Yeah.
I have one follow-up comment to Scott there, and that is, when you looked at particularly the Odfjell, one of the slides that he had, you saw some of the rigs, including your 2, are floating out of Norway and to, what should I say, more payment-willing markets. Of course, 2023, particularly Norway, is a little bit slow. But the sanctioned project that was sanctioned, or the PUDs that was delivered late last year, they will kick in from 24, 25, 26. So, and based on the operators or the oil companies panel earlier today, you see exactly that when the others kick in. And of course, there will probably be a big shortage, and that will probably drive your prices on the premium rigs in that market also from 24. I'm pretty sure of that.
And on that note, Richard, you haven't moved jackups out of the North Sea yet, but maybe see that you're moving out jackups until the market starts tightening?
We haven't yet. Others have. We are bullish on Norway long term, right? And so obviously as rigs leave the market, it's a very narrow and small market. That's good for us, right? So, you know, if there is an opportunity outside of Norway, we absolutely will look at that. But I think we're focused on Norway and expect that market to come back second half of next year.
Perfect. And then going a bit over to the supply side, the other panelists were pretty vocal that you will not see floater new builds, but some people at least think there's higher likelihood that you may see a jackup new build eventually. So just any thoughts around that? Maybe Magnus, you want to start? What would it take to see a jackup new build?
I think it's very similar to what was said in the previous panel. So first of all, there are not many yards to take on the work any longer. So the yards that are typically built these rigs, historically they are busy doing other construction. And secondly, the prices are, I think, 15 to 20% higher than they were in the previous cycle already. So you need to pay at least $250 million for a new jackup new build today, and you have a delivery time of 2 to 3 years. You would need a very solid long-term contract to even make sense of it in quite high day rates, higher day rates than you have already seen in the market. So I don't think it's just around the corner. And I think as well there's more reluctance from owners now as well to jump into the new building games again.
Any other thoughts around that? Or, yeah.
I'm just repeating the last panel and say that it's completely not going to happen over the next 3 to 5 years, 3, 4 years, I would say, that they will build submersibles. I think the contract needs to be much longer, and you need a rate level that we have never seen before to be able to do that. And with the oil companies showing the, let's say, shortness in the planning and thinking, I think that makes it extremely difficult in combination with the finance market, where it's almost impossible to get cheap financing. So all negative, let's say, parameters will block that for happening for the next years.
And then going to reactivations, we talked about that in the other panel as well, but sort of the main hurdles there, and you, Bjørnar, you've been through reactivations now and are currently involved in that. The cost inflation and yard availability, taking all those into account, can we see high risk on reactivations going forward?
I think it depends if you plan it well. I think I'm supporting Kjetil Gjersdal's comment from Odfjell drilling. If you plan it well, I think it's doable. But of course, there's an underlying push towards sub-suppliers on wage escalation and the general cost escalation. And of course, for the yards, I think yard capacity, you will always find a solution to that. It's all about cost by the end of the day. So it will drive the cost somewhat. But we had, as you indicated there, we just took out a couple of weeks ago the Blackford. That was done. We had a plan of doing it for 15 million, and I think we did it for 14.8. Well done by the team. But of course, some of it was committed a little bit earlier, not hit by that inflation. So I think with a little bit of planning, it's doable, and I don't see that extreme risk in it, planned carefully.
Richard, you have a couple of drill ship reactivation candidates. How do you consider those, and also on the discipline in the market for reactivating rigs? How do you see that?
Yeah, so on the drill ship side for us, we really have one 7G rig, the Melton, which we acquired through Pacific. We've been very clear on that it's plus or minus $100 million to bring that back to market, probably 12 to 18 months. As we think about the parameters, if you will, obviously we need a contract that not just gives us the money back, but a return on that investment. we need enough time to do the job, right? So it's 12 to 18 months. We need the customer needs to wait to be able to wait 12 to 18 months. And then we need a contract as well that protects us, so the customer can't walk, right? And that's not always the case. And we've actually, I think, gone one step further as well and said, in the near term, given our focus on returning capital, we would also need the customer to fund the majority of that money up front, right? And so, and there are some opportunities out there around there. They're few and far between. But if we have something that hits all of those criteria, we'll do it for sure.
Follow up on that. I think all the players, or at least most of the players, will have that capital discipline, as you just mentioned there. I think nobody would, what should I say, finance oil companies up front anymore. I think there's been so much fatigue and money lost that this time I think we need our money back. And I think there's the boards and the managements have that discipline. Yeah. That's what I see now in the market.
Yeah, our cost of capital is higher than operators. And we've been funding them, unfortunately.
And on that note, banks, at least some banks, have been reluctant to give financing to drillers and wanting out of the space. With the recovering market now, are you seeing any change from the banks in terms of being more supportive?
I'm happy to go first. I think the answer is yes. I think they're picking spots, if you will, but the banks are generally being supportive going forward. Obviously, there's returns that they need to make, but ultimately, obviously, we talked about on our call that we're looking at our capital structure right now and in discussions with the banks about simplifying it. So we expect the banks to be supportive.
We have at least one supportive bank that has been through us, through the cycle with us, and they continue to be supported. Maybe on the Scandinavian side, banks are pulling out from all oil and gas, but it's still very good to see now in the bond markets that we recently did 2 financings. It's very much open for business and a lot of interest. So I think you'll see more kind of capital sources from there, a bit skewed away from traditional banks, but also banks have a tendency to return to markets, cyclical markets, a little bit later than maybe equity. But so hopefully some of them will return.
I was going to add, I'm curious to see where Richard goes with that, because for us, we've had great support with the stakeholders and the banks along the way. Really for the last 2 years since we stacked the Mira. But I'm just not seeing new access or new issuances. Of course, they're working with us. I think they've learned they don't want to own the equity. They would like to be creditors and stay that way. But, we are building the case. There's a compelling argument here as we have the financial discipline, the contracting discipline, then really as the yields and the costs come up of that, they need to be and have exposure into this market, because this is a market that's not going away and that will continue to be needed with offshore. So it makes sense. I think the consolidation is interesting on some of the bank, a couple of banks owning larger positions than maybe they like. But in the Scandics, like he was mentioning too, the ESGs is highly important for us, and to figure out what is it, what can we do, and what technology can we bring to the rigs, and how to get to the net zero perspective of drilling that way. And the faster we do all those things and maintain the discipline, then I think we'll begin to see access again. So I'm watching you now because I'm curious to see that. I mean, I think the shelf stuff this summer was a great sign, and that probably was the first to start prompting up with Transocean and where we're at now.
I think our experience is the same as the rest here. I think traditional bank, difficult, close to impossible, but a little bit less impossible, probably, difficult. But it's good to see that the bond market is partially back again. And probably some of the banks, a little bit over time, with some, what should I say, good contracts and good assets, they probably will cherry pick a little bit. I think that's what's going to happen. And of course, then time runs, and then there will be solid cash flows, and of course things change over time. Then probably some, I would say, specialist bank probably will come back again. But it's a typical cycle.
And do you think that the fact that the bond market is now open again for rig players, do you think that can be a catalyst for M&A or fleet expansions?
You shouldn't disregard that.
Yeah, moving further on to consolidation, and in the jackup market we haven't seen that much consolidation. So maybe we can talk about that. What's the expectations going forward? Maybe see more of it. Magnus?
For our sake, I think we're very happy with having 24 rigs, decent size, modern rigs. So, but yeah, the jackup market is more fragmented, so maybe a bit more difficult to see M&As there. It's been more, like you've seen Middle Eastern players being very active on asset transactions, but not that many companies merging. So it's difficult to say.
Floaters, right? But 5 years ago, we went around and looked at every yard with every jackup that was there, and I forgot the count, the China yards, and it was pretty significant. And I probably have a report in a shared file somewhere of the condition of all that. And hearing him talk today and have that zero capacity left, I'd say the consolidation has taken place. With ADNOC and the growth in the Middle East, it's there, it's happened already. So there isn't as much more to go forward, and you have some pretty significant market share between the two of these guys and a few others that it's strong right now. And I think that's where the pricing, and you start to see that rebound come back. But it's impressive though to see it from where it was 5 years ago and the new build supply to where it is today, with basically everything's accounted for. I think we're seeing the same on the floating side as well. So.
Anything to add on M&A, Bjørnar?
Oh, I think we have to. You heard a little bit of what the others in the last panel said. I think there will be a cleanup where there's been some mergers and acquisitions now, and of course they need to sort out the assets so you have an optimal way of running it. That's probably what's going to happen. I think there will be some movements there. At least that's what I anticipate. So we'll have some more clear portfolios with what should I say, standardized setups. You can run it super efficient. I think that will happen.
Perfect. I think that concludes our panels on offshore drilling. Thank you everyone for listening in, and to the panel participants.